morning, welcome back to the Junius Maltby channel. As oil flash crashes, one trader says the commodity sell-off is the single largest macro factor right now. This article comes from Zero Hedge and it's from May 5th. But in 10 minutes time, oil plummeted $1. Volume had surged 14 times. And the reason I bring this up is because, as you know, and we'll show you some charts later on, this will play into some of the discussions today. Metals are heavily tied to the price of oil due to production costs. So keep this in mind as we discuss some of the things later on. A lot in store for you today to discuss, a lot of headlines. Some subscribers emailed me several articles that we'll touch on as well. So this is going to be a lengthy and exhaustive exploration of current events. Let's start with the self-limiting shorting attacks and gold futures nearing exhaustion. Gold futures shorting attacks are very real, with telltale volume and price signatures unlike anything else. It's critical to realize these rare events are only responsible for a tiny fraction of all gold selling. The vast majority of the time, gold sell-offs are driven by other, far more normal factors, not shorting attacks. These isolated, anomalous episodes are often cited as proof the gold price is actively manipulated. But whether that's true or not, gold futures shorting attacks can only explain tiny, sporadic swaths of gold price behavior. When they occur, their impacts can definitely be outsized, but these are always short-lived. That's because the huge selling necessary to execute a shorting attack is far too extreme to be sustained. Speculators' gold futures trading is a sentiment multiplier. When these guys are buying and driving up gold, other traders grow bullish and start committing their own capital. This virtuous circle feeds on itself. But when speculators are selling gold futures and pushing gold lower, the rest of the traders get nervous and bearish, so they tend to join in the selling, exacerbating the downside. Traders key off gold futures action. On top of this, gold futures inherently enjoy extreme leverage to gold, which greatly amplifies their impact on its price. Each gold futures contract controls 100 troy ounces of gold. At $1,250, that's worth $125,000 in notional terms. But the margin required to trade a gold futures contract is merely $4,200. So a speculator running minimum margin can employ extreme leverage nearing 30 times. The legal limit in the stock markets is 2 times. Compared to normal gold investors buying outright at 1 times leverage, every dollar of capital bet by futures speculators can have 20 times to 30 times the gold price impact. So even though gold investment dwarfs gold futures trading, on a short-term basis, the latter is like the tail that wags the gold price dog. This extreme leverage inherent in gold futures is the only reason shorting attacks using them are even possible in the first place. The mechanics of a gold futures shorting attack are simple. A large speculator or group of them short sells gold futures contracts at dizzying rates, only sustainable for minutes on the outside. That's far too much selling pressure for gold futures to absorb radically beyond normal trading tempos. The resulting extreme sell-side imbalance forces gold prices to plunge before enough buyers emerge to absorb that selling. The speculators executing these attacks hope they spawn widespread gold futures selling. Because of gold futures' extreme leverage, traders can't afford to be wrong for long. At 25 times, a mere 4% gold price move against a position results in a 100% loss of capital risked. So the short sellers hope their selling blitzes will force opposing long-side speculators to capitulate and sell, usually via mechanical stop-loss orders. This additional selling of gold futures long contracts drives its price even lower, tripping more stop-losses already in place. Then, with gold sharply lower, the speculators who launched the shorting attack start to gradually buy gold futures to cover and close their positions. Buying back at lower gold prices than they sold at leads to profits. This whole process is very fast, measured in minutes, for shorting and hours for covering. Inarguably, the only reason to sell 20,000 gold futures contracts within minutes is to brazenly attempt to manipulate gold's price lower. Long-side speculators who want to exit positions never sell so fast, since it blasts gold lower, wrecking their exit prices. And the same is true for normal short-side speculators. If they expect gold to drop and want to establish shorts, they execute their selling gradually for the best entries. Long-side and short-side speculators alike want to sell gold futures at the highest gold price possible, so they don't sabotage their own exits and entries by unleashing far more selling than the market can bear. Normal rational speculators enter and exit large positions relative to market volume gradually over hours. A 20,000 contract buy or sell order broken into pieces and spread across hours will have a far smaller price impact. The bottom line is gold's sharp pullback in recent weeks was sparked by a series of gold futures shorting attacks. Some large speculator intentionally dumped massive amounts of gold futures contracts within minutes, several different times. Such extreme selling so fast was way too much for markets to absorb, so gold fell. This shifted gold psychology to bearish, resulting in cascading follow-on selling by long-side traders. That article is quite dry, boring, and extremely long. I only gave you guys snippets of it. But I wanted to use it as an opportunity for us all to look through that window, that one factor that might be affecting gold price at certain times, especially when we see these dramatic swings in buying and selling and these price drops, which we must understand also is tied to other factors as well. I'm not saying that 100% of the reason we saw these recent price drops was due to direct manipulations in the market. However, I do believe they are a factor. Is gold signaling the next financial crisis? The table above calculates the COMEX Bank's paper gold positioning going back to 2005. As you can see, currently the net short position and the net short position as a percent of total open interest had reached a relatively high level. This is typically when the banks engage in raiding the COMEX by unloading massive quantities of paper gold in bursts in order to trigger hedge fund stop-loss selling. It serves the dual purpose of pushing down the price of gold and providing a relatively riskless source of profits for the banks. This is a cycle that has repeated numerous times per year since 2001. This time, however, more than any other time since 2001, the sell-off in the price of gold is counterintuitive to the collapsing financial and economic condition of the United States specifically, and the entire world in general. The likely reason for the current price takedown of gold is an attempt by the elitists to remove the batteries from the fire alarm mechanism embedded in a rising price of gold. An alarm that lets the populace know that there's a big problem that will hit the system sooner or later. An alarm that lets public know systemic failure is beyond government and central bank control. A similar manipulated takedown of the price of gold and silver occurred in the spring of 2008, ahead of the great financial collapse crisis. Gold was pushed down to $750 from $1,050, and silver was taken down from $20 to $10. This price decline was counterintuitive to the collapsing financial condition of the U.S. financial system, which had become obvious to anyone not blinded by the official propaganda at the time. Of course, after the financial collapse occurred and was addressed with money printing, the price of gold ran up to an all-time high. All of these articles are coming to us from different corners of the internet and different financial news outlets of the alternative genre. And it's amazing because I'm noticing a theme here. This next article, Central Bank Market Rigging, horrified about the biggest global bank run in history. The Fed and central banks are manipulating the gold and silver price because they are horrified that the biggest global bank run in history will take down the entire system. Unfortunately, a lot of investors are still being misled about the fundamentals of precious metals market manipulation. While the Fed and central bank are indeed intervening in the gold and silver market, they are also propping up the majority of asset values across the board. This is especially true for most stocks, bonds, and real estate. Yes, it is also true that billions of dollars worth of paper, gold, and silver are dumped into the market in nanoseconds during very light trading days. Thus, the impact is to cap the gold and silver price, making sure that 99% of investors stay fast asleep. These are the very same investors who the central banks are working extremely hard to keep their funds placed firmly in stocks, bonds, and real estate. Also, remember we talked about oil earlier. Here you can see some charts showing us that oil and metals are tied very closely together. Central banks terrified about the world's largest bank run in history. What the Fed and central banks are really worried about is the world's largest bank run in history. This is why they are now throwing everything and the kitchen sink to prop up the markets. We must remember all the debt, derivatives, and money printing is being done to keep people from freaking out and starting a global bank run. Thus, the Fed and central banks are manipulating the market by controlling, quote, market psychology. This goes well beyond gold and silver price rigging. It's a full spectrum, wide-ranging, all-encompassing market intervention never seen before in history. This chart provides the reason, numbers, why central banks continue to rig the markets. Here you see Global Mainstream Asset Universe 2015. Look at the amount of money measured in trillions of dollars tied up in these different asset classes. Real estate, 217 trillion. Securitized debt, 94 trillion. Equities in the stock market is $55 trillion. And then you have gold and silver, just a measly 3.1 trillion. Now this is in 2015, and these numbers probably have grown exponentially since this time period. Article finishes off with, we are now experiencing the beginning stages of the disintegration of the U.S. and global oil industry, while the central banks continue to prop up the markets with money printing and massive liquidity. The biggest global bank run in history is on its way. Interesting piece of trivia news, LBMA, London Bullion Metal Association, to publish precious metal holdings in London vaults. Monday, May 2017, the LBMA and the LPMCL are delighted to announce that from summer 2017, the LBMA will be publishing the gold and silver physical precious metals holdings of the London vaults, with the platinum and palladium holdings to be published at a later date. The data only includes physical metal held within the London environs and does not include precious metals physical holdings readily available at short notice in other secure overseas vaulting facilities. Gold likely to be supported by geopolitical tensions. This was from CNBC. Gold could rally on safe haven buying, but it may not last ahead of likely interest rate hikes from the Fed. This is Robin Barr of Societe Generale. India, April gold imports more than double to 75 tons. Mumbai, Indian gold imports during April has increased drastically to 75 tons, which is about twice the increase when compared to a year ago period. This increase is believed to be on the back of strong demand during the festive season. Rise in imports in India, which is the second biggest gold consuming country after China, will have an impact on the gold prices, as the global prices was seen lowest in 7 weeks. Louisiana bank failure is costliest since the financial crisis. Regulators on Friday seized New Orleans-based First NBC Bank in the costliest bank failure since the financial crisis, with cleanup costs estimated at $1 billion. This was April 28th by Jeff Amy AP. The Louisiana Office of Financial Institutions handed the bank to the Federal Deposit Insurance Corp. in the fourth failure of a federally insured bank this year. Hancock Holding Company of Gulfport, Mississippi bought $1.6 billion in deposits and $1 billion in assets, including $600 million in cash. Hancock will fold First NBC's 24 Louisiana branches into its Whitney Bank unit, and First NBC's 5 Florida Panhandle branches into its Hancock Bank unit. Billion-dollar bank failure. Guarantee Bank of Wisconsin closed by feds May 5th, 2017. For the second week in a row, a billion-dollar bank was closed by regulators. Last week, it was First NBC Bank of New Orleans, and today it was Guarantee Bank, Milwaukee, Wisconsin. Overwhelmed by bad loan and comptroller currency, shuttered Guarantee Bank and appointed FDIC as the receiver. So now we're seeing bank failures. It seems like they're increasing in velocity just a little bit. I wonder if this is an indicator of things to come or not. Over half of Canadians are $200 or less away from not being able to pay their bills. More than half of Canadians are living within $200 per month of not being able to pay all their bills or meet their debt obligations, according to a recent Ipsos survey conducted on behalf of accounting firm MNP. For 10% of Canadians, the margin of error when it comes to household finances is even thinner, at $100 or less. This bubble could burst any day. By Brian Maher. All hell is about to break loose in China. Such is the professional judgment of Kyle Bass, boss of Heyman Capital. The devil of this hell is a banker, and it's credit that spreads the fires. Chinese credit expanded too recklessly and too quickly, argues Bass, and it's beginning to unravel. In a generation, China has gone from economic blank to the world's second largest economy. Its growth spurt has no equal in history. Cheap credit, cheap debt, that is, made it possible. After peaking around 15% in 2007, Chinese growth has slackened to about 6.5%, its slowest annual growth rate since 1990. The IMF projects it to decrease to 5.8% by 2021. Meanwhile, the debt keeps piling up higher and higher, and the greatest Ponzi scheme in history schemes away. Bernie Madoff must be green with envy. Regards, Brian Maher. And in very dark news, Venezuelans accused of rebellion are hauled into military court. Boy, the world has seen this before. Procedures are closed to public. Caracas offers few details. These are times of dictatorship, Governor Capriles says. Hundreds of Venezuelans arrested in the past week have been tried in secretive military courts, a new maneuver by the government of President Nicolas Maduro, as he fights to retain his grip on power in the face of escalating political opposition and massive street protests. Those taken into custody were charged with crimes including rebellion and insulting authorities, and some were sentenced within hours, according to civil rights groups. Thousands of people have been detained across the country in recent months, with authorities rounding up politicians, activists, student leaders, even shoppers waiting in queues to buy food, who made complaints police officers decided were out of line. Triple-digit inflation and stark shortages of food and other basic goods have spurred demonstrations drawing hundreds of thousands of people, with street battles claiming at least 35 lives in the past month. Videos of National Guardsmen pursuing young protesters and whisking them away on motorcycles have gone viral online. Well, there you go, Venezuela, showing the world what happens when we do not heed the rules of economics. That leads to unrest, starvation, inflation, all kinds of disruptions in what everyday normal life should look like. So there you go. We've covered quite a few different topics today. I mean, we literally went around the world. We looked at China. We looked at Canada. We're looking at Venezuela. We're looking at the global market for gold and precious metal investment and possibilities for manipulation taking place. So there's a lot to think about, a lot to discuss down below in the comments. Thank you for being part of the Junior Small P channel once again. Don't forget to like, share, subscribe, and if you feel inclined to do so, you can support this channel, its content, and myself through Patreon. You can become a patron yourself. There's a link on my blog, which is, if you haven't been to the blog yet, go check it out, juniusmaltby.blogspot.com. And I'll throw a link for the Patreon down below if you wish to click on that and explore that as well. I have been doing some things lately where I will include content for patrons, and I'll release certain things a little bit earlier than other times. And I need to figure out exactly what you guys would like to see in there. as far as exclusive content for patrons. All right, thank you all. Have a very good rest of your day, and thanks for being part of the Junior Small P channel.